This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone. It's Liam Garman here, Managing Editor of Real Estate at Momentum Media, the team that brings you the Smart Property Investment Show. And today I am joined by my co-host,
Emilie Lauer,
to unpack the biggest news this year. And we've actually hit the ground with a bit of a sprint this year in terms of news that's going to impact the property market and investors going forward. But before we dive into all of that, Emily, I've now got French ads appearing.
and I am loving it.
Yeah.
I think it's time for us to branch your French. So
I know.
we're gonna have French lessons very, very soon. I know you wanted to learn Italian. Well, I think French will be stronger, especially because you love French, don't you?
I do. Because you'd get angry at me if I said anything else. I was browsing the internet before, and I had a few ads come up for Fiddy mortgages, and I didn't know what it said at the bottom because I've been apparently browsing France too much. But of course, only a few weeks ago, we had Josephine Caribs on the podcast talking about investing in Italy. Now, I'm on my day 290th streak for Duolingo Italian.
Ooh,
I know, it's pretty
I'm proud
good.
of you.
It's pretty good, but I don't know how to speak anything. I'm sure I know a lot of the words. Affitto, rent.
Yes.
Yes, sei, castello, castle. You know, like we.
And vogliamo affittare un castello.
Okay, slow down. Vogliamo we go?
We want?
We want. Okay. Yes, yeah, yep. Go on next.
Affittare
To rent
un castello.
a castle. Boom.
We
done.
want to rent a castle.
So if anyone wants to know how to rent a castle or buy a castle in Italy, and you want to know how to do it, some of the tricks behind it, some of the taxes, some of the unforeseen hurdles that you might have, or even if you want to renovate a €1 house, go back. We released that on Boxing Day.
Yeah, which is perfect day.
Perfect day. Everyone's relaxed during this period. Go listen to that because that will be fantastic, and you might surprise yourself with some interesting ideas you get with that. But turning on to the big news, sooner rather than later, ANZ forecasts interest rate cut in February. Now that seems very soon.
Yeah, well, it's just a couple of weeks ahead. And so ANZ came to us, when was it, like a couple of days ago, with a new forecast which said that basically the first cut will be in February when the RBA meets for their first meeting of the year. Now, ANZ has joined the Commonwealth on that idea, but other banks like NAB and Westpac are still expecting the first cut in May, which just a little bit of difference here and a little bit of different ideas.
Well, it's quite interesting because we have seen with the recent CPI data that came out that we have had a reduction in inflation. And from the CPI data that was released at the end of last year, there were lingering concerns from economists and even property investors that while, yes, top-line inflation figures have dropped, which is a good sign that there will be cuts on the horizon, well, the trimmed figures didn't represent the same drop. So for people that want to know a little bit more about that, ultimately, with things like $300 energy rebates that a lot of families were getting, or say reduction in childcare costs, or any of these things which might help the back pocket, well, it doesn't actually mean that things are getting cheaper. So if you have a $300 reduction on your energy bill, when you're reporting and the ABS is analysing, well, actually, how much are people spending on energy or this or that? Well, the data that they're collecting is less because people are spending less on it. But the actual amount that's being paid, well, it's actually gone up. It is still going up. It's just being masked. So with those trimmed inflation figures, that it wasn't decreasing enough to necessarily justify a rate cut, which actually means this is quite an interesting forecast. I don't know, Bendigo's come out with those trimmed inflation figures as well, that a rate cut is likely in the first half of the year. Now, one thing that our listeners need to remember, just because a rate cut is announced doesn't actually mean the banks will pass it on.
Yeah.
So if you're banking right now on that 25 basis point cut and you're thinking, okay, cool, if this precipitates a few further cuts, easing the weight on my back pocket doesn't necessarily mean that banks will pass it on.
Yeah, and I also want to point out that the banks are very diverse and diverging in the numbers of cuts that they are expecting this year. So the ANZ still expects 2 cuts in 2025, Commonwealth and Westpac 4 cuts, and NAB came very strong with 5 cuts throughout the year. This means that, first of all, we don't even know what's really going to happen, as you mentioned, but it means more or less relief for borrowers, which could go from $92 per month with 1 cut to $441 per month with 5 cuts, which just going to depend on the banks.
That is actually quite a very big difference.
It is a very big difference.
So let's go through the maths that you've very, very helpfully pulled together in terms of the impact on borrowers, assuming that the banks do pass these savings on to the borrowers. Emily, talk us through the impact that it will have.
Well, over a 600,000 loan, which will still have 25 years going on, we could see a reduction of $92 per month with 1 cut. And then we could see a 441 cuts per month if we have those 5 cuts rate. Now, let me pull the data more. So under 1 cut, we would get $92. Under 2 cuts, the drop would be $182. And under 4 cuts, it would be about $357. And under 5 cuts, $441, which is monthly.
Monthly, yeah.
Which is massive.
Yeah, it sums to quite a lot over the year.
For the borrowers, I'm wishing the 5 cuts. But, it's just going to depend on how the market evolves and what's happening with the RBA. Now, people are expecting that first cut in February, but no one is really certain it's going to happen. So we're going to have to wait.
No, of course, and this will tie very closely into a federal election, which has to happen before
17th of
May. So obviously, well, we expect there would be, I don't say have to, but we would expect that perhaps the RBA might have a little bit of pressure from the government to have some rate cuts before then. Now, interestingly as well, this $441 with 5 cuts for a $600,000 loan, that's going to put a lot of heat in the market. One other thing that's come up only recently, only within the last 48 hours, Emily, was that the opposition leader, Peter Dutton, has come out committing that if the coalition were to win the next election, that first home buyers would be able to access up to $50,000 from their superannuation to buy their first home. So in addition to the cuts, you've got that heat that will be coming in the market as well. To be honest, with these 2 things, my opinion, between just these 2, I expect we're going to see a pretty hot 2025 in the property market.
Yeah, and look, I think the coalition has really put an emphasis on the housing crisis, on their pledges and on their campaign. So they also want to unlock more homes by reducing immigration. And they've committed $5 billion to support the building infrastructure for new housing, like water, power, sewage, and access to roads for new constructions.
All of this doesn't come without some new regulations and risks. I know our listeners are sick of it. You're sick of more rules being placed on your shoulders. You just want to invest. You just want to increase housing supply. But Emily, Aussie sellers at risk of 15% withholding under new ATO rules. What the? That's a pretty...
That's massive, 15%.
When you sent that through, I think it was about a week ago when you sent that through, I was like, you sure?
Yeah, unfortunately, yeah. So look, that's something that passed on last year on the 28th of November. But that just came into effect in January. So before, you had under the foreign resident capital gain withholding, so foreign investors and Australian homeowners that wanted to sell their property that was above 750K were to ask the ATO for a certificate that proved they had Australian permanent residency or they were Australian residents to get that money back, those 12.5% withholding rates back. Now the rules have changed, so every Australian homeowners that wants to sell their property needs to get that certificate. The 750K threshold has been scrapped. The 12.5% moved to 15%. So people who want to sell this year in Australia, they need that certificate. Otherwise, 15% withhold by the ATO.
You don't want that. You don't want that if you're in a bit of a rush. So sellers who fail to provide the clearance certificate by settlement will have the withheld amount paid to the ATO. The clinch with refunds issued after the next tax return is processed.
Yeah, so you're going to have to wait next July.
That's just,
So
gosh.
you could wait months and
100%.
months.
Yeah, I think everyone would be very inclined to be lodging their tax return on July 1.
My God, yes.
If that was the case.
Now, the ATO said usually the certificate comes within a few days, but can take up to 28 days.
Up to 28?
Up to 28 days. However, like the little trick, if you know you're going to sell your house this year, you can actually apply for it straight away because the certificate is then valid for 12 months.
Yep.
Which, would make things
easier. People, life throws curveballs at you. You don't know what's going to happen next month. You have a good idea, but you don't know what's going to happen next month. Just keep applying for it. Just set a reminder on your phone. Apply for it every 12 months because bloody hell, 15% withholding under new ATO rules. That is brutal, and we don't want the listeners of the Smart Property Investment Show to be slogged with that. You now are armed with the knowledge to protect your back pocket. We're going to go to a quick break, and when we're back, we're going to unpack Australia's rental prices and some worrying information coming to investors. That's the slowest growth since late 2021, and we'll be back in just a second. And we're back, Liam Garman, Emilie Lauer, the team behind the Smart Property Investment Show, with our first editorial news podcast of the year. And I was hoping that the few weeks after New Year's Eve would be a little bit quieter. It hasn't been quiet.
Man, I came back from holiday full back on deck, Yeah,
like you came back only 48 hours ago or something. And I'm like, please help me.
And I think I wrote like 6 pieces already, like in 48 hours. I'm like, oh my goodness, what happened?
Yeah, it's been, it hasn't slowed down as well. The bank's coming on with a potential rate cut. And I mean, there's so many things lingering in the background as well. Rezoning, new development land that's just been snapped up. It's really been happening. Now, some recent data. Now, obviously, all this was collated in December last year. New information has come out showing that, Australian rental prices are kind of stagnating a little bit.
Yeah, so apparently, according to the data, the December 2024 quarter was the slowest since late 2021 for national rental growth, which slowed to 1.6%, with the median weekly rent for all dwellings nationwide reaching $620. Now, it's been slow for that December quarter, but the year still grew. So there's still been a growth over 2024. Now, over that quarter, units saw a bigger growth than houses. So unit rental saw a 7.1% increase compared to 5.9% for houses. That's over the year. One thing that's quite interesting with this data, so you've got a 7.1% increase for units over the year and 5.9% for houses over the year. Off the top of my head, house prices grew by 11% over 2024, which shows across the board that rental yields are kind of taking a step back. Yeah. But I think, like with all the housing crisis and cost of living crisis, rent can't increase too much because people can't afford to rent afterwards,
There is a ceiling to how much you can charge with that rent unless you do have some level of wage increase. Prices in Brisbane and Canberra, however, bucked the trend.
Yes, so Brisbane saw a median rent for housing is reaching $650, which is a 1.6% increase on the December quarter, while the rent for units rose by 3.5%, reaching $600 weekly. Similar for Canberra. However, Canberra saw no median houses rent increase, no growth for the houses, but their unit rent increased by 5.5%, reaching $580 weekly, which has been pretty good for the ACT and Brisbane. Now, in that quarter, in the December quarter, it's Brisbane and Canberra that have taken the lead. But over the year, 2024, it's Adelaide and Perth that had the stronger increase in rent. So Adelaide's weekly rent for all dwellings increased by 7.4%, and Perth's rental prices grew by 8.3%, which is quite a lot.
And Sydney and Melbourne?
Stayed flat.
Yeah, wow.
Yeah. So they stayed flat, but Sydney still has the highest median weekly rent of the country with $730 across all dwellings. And Melbourne also stayed flat with a weekly rent at $570.
Now, I would infer from this. Now, all of our listeners, this is an inference according to the data. This is not me reading from the data, but with Sydney in particular, with the weekly rent remaining flat, that this would tell me that supply is picking up quite a lot, given how much population growth we've had in the city of Sydney, that there is sufficient supply at the moment to meet that increased demand.
Yeah, I'm actually curious to see if rent will decrease a little bit in Sydney in the coming months, especially if renters have access to that superannuation, if coalition passes, if they're going to be more first home buyers or not. So that's going to be quite interesting, and we are definitely going to keep an eye on that.
Now, although we're predicting that Sydney is seeing an increase in supply, that is not the case across the country. There was a recent report issued by InvestorKit highlighting some areas where Australia is facing quite severe housing supply shortages, but where you have supply shortages, you do have investment opportunities. Emily, what are we seeing there?
Yeah, so that white paper has analysed about 330 regions across Australia using the SA3 region, which are regions populated between 30,000 and 130,000 people. And they have assessed all of these regions based on factors such as supply risk, future supply risk, housing availability, population movement, price pressures, rental pressure, and price trends. And they came with about 25 metro and regional area where there is a significant housing supply shortage. Out of all of these 25, Perth and regional Queensland have the top 5 markets.
That's quite amazing. You take us through that. What are those markets?
Yes, so in Perth, we've got Fremantle, Bayswater, Bassendean, and Joondalup that are, I'm not sure if I'm butchering those or not, which are
Just dive in two-footed, yeah.
So they're basically those 3 in Perth. They're basically key hotspots for investors because there is housing demands that is exceeding supply. They've had a lot of population growth, and there's been a decline in home and buildings approval.
Wow.
So basically, if you want to go and invest your money, like these areas are where you're basically guaranteed to have renters.
Yeah.
So that's for Perth. Now in regional Queensland, Mackay and Gladstone are also key areas for the same reason. So more demands than supplies and high population growth. So these ones are really big. They're the top 5 markets. Now, I also want to point out that there is a highlight in South Australia. So areas like Prospect, Walkerville, Mitcham and Onkaparinga They're also highlighted as very hotspot for investors for housing shortages because they've got high population for limited supply.
You nailed that pronunciation.
Okaparinga.
Yeah. I was waiting, and then you said it so naturally. It was almost like a French word. Hey, how long have you been in Australia?
2025 is my 10 years anniversary here.
10 years.
So in July, it's going to be 10 years.
We're gonna have to have an SPI 10-year party. Have you been to Queensland?
Yeah, I've been to, I did like the backpackers thing, the little road trip.
Did you drive?
So my first year, I did the wrong road trip, yeah? So my first year, that's a funny story. We did from Sydney to Brisbane.
Yeah, yep.
And so we stopped in all the spots like along the coast. And once we were in Brisbane, I was supposed to take a flight. I think it was on a Saturday. I thought my flight was on Sunday.
Oh,
and I missed my flight.
That's bad.
Just to go and see the koalas in the Lonely Pine Koala Sanctuary. So I've got my cute pictures with the koala instead of being on the fly.
Nice. Yeah.
It cost me $400 that day. But
well, next up, we're going to have to take you to Mackay and Gladstone.
Yes.
Central Queensland. If any of our listeners are up in Mackay and Gladstone and would like to reach out, we'll...
I've been to Townsville on Magnetic Island.
Really?
And Cairns,
Yeah. Well...
Magnetic.
It's Queensland's a good part of the world. Massive growth over recent years, and I think a lot of investors are very happy with how that's going. But do read into the report released by Investor Kit and Emily's reporting on the Smart Property Investment website, because that is absolutely fantastic information for investors. We're going to go to a quick break, and when we're back, Victoria's Airbnb tax nightmare. Yes, I'm calling it a nightmare. We'll be back in just a second.
At Invictus Australia, we're all about supporting veterans and their families through the power of sport. Whether it's helping veterans stay connected with their local communities, assisting them in their transition to civilian life, or promoting mental and physical well-being, we're here to support them. From grassroots programs to international sporting competitions, Invictus Australia empowers veterans to take on new challenges, stay active and thrive. Join us in building a stronger, more inclusive community through sport, because together we are unconquerable. Visit invictusaustralia.org to find out more.
Liam Garman, Emilie Lauer, your team at the Smart Property Investment Show. Emily, you do all the work nowadays.
Well, except that one.
Except this one.
So this one...
So I'm going to have to speak to it myself.
It's your story.
See, I usually just editorialize everything.
I know. I'll send you my stuff.
I just give opinion. I just give opinion on do I think an announcement's good or bad. Well, I already called this one a nightmare. Victoria's Airbnb tax comes into effect. Now, I think if you're already running short-term rental accommodation in Victoria, I hope you already know about this. I'm sure you do. The Victorian state government has unveiled last year, as of 1 January, a 7.5% levy on short-term rentals. Now, isn't levy a nicer way than saying tax?
Yeah.
Yeah, I mean, you can cover it up if you want. But so the way this works, as I was talking to a few people that were commenting on this, the 7.5% levies on the sum of the whole thing, which I just find it's quite gobsmacking, quite interesting. So say, Emily and I were getting coffee just about an hour ago, and I'm talking through this, and this just makes no sense. So if you've got a $200 a night short-term rental, like Airbnb, and then say you've got a $50 cleaning fee and you've got GST wrapped up on all of those things, the 7.5% levy is calculated at the final amount. So if you're at checkout and with GST and with whatever the cleaning fee is and the service fee, etc. So say your $200 Airbnb goes up to like $275. That 7.5% is calculated on that $275. It's the total price. It's of the total price. So that profit kind of land tax is calculated, including GST, which is you're taxing a tax, which is just quite odd. And then it goes to the owner has to pay it. Now, the government has said that they expect that the levy will raise about $60 million annually, which will be allocated to social and affordable housing projects. Now, a great, I think, intent. It's a good thing to have more affordable housing. Execution probably misses the mark here, given that the concerns that this will have on Victoria's tourism market. Very quickly, a 3 or 4 night stay can become really unavoidable, because after just a few nights, you're basically, when you pass these costs on, you're paying for an extra night that you're not staying there. So owners earning up to $75,000 from their rental will need to report their earnings annually, and that first statement will be due in January 2026. One thing that I find remarkably confusing about this is that your reporting is not in line with the financial tax year.
Yeah.
Which I find that quite confusing, because you would almost expect that if you're presenting how much your asset has earned over that time, that you would align it with the tax year. Do not fall into that trap. Listeners, our amazing listeners, don't fall into that trap. It's January 2026, and anyone earning above that $75,000 figure must submit quarterly returns. Now, this does have the chance of creating a few knock-on effects. So in this legislation, the Victorian state government has also said that local governments are given the authority to regulate the number of short stay rental days. So effectively, local council can come in and say, well, we believe our suburb has too many short-term rental accommodation offers. We're going to cap everyone at 100 days each or 50 days each. Notionally, that's what local councils can do, which raises a little bit of a concern to me, because we've seen a lot of these anti-tourism movements, Emily, that have happened in, Barcelona and areas like that, and I remember when I was in Greece last year, and there was a huge anger that a lot of people held to Airbnb because they saw it as taking up housing supply and driving up rents and driving up house prices. Obviously, despite the fact that if you're coming in to a town in Greece and you're probably dropping like 10,000 euros while you're there or whatever, you're contributing to the local economy.
Yeah, but you know what? I think you're right. I think, someone who decides, in my own view, someone who decides to rent their places short-term, their investment property short-term, is also maybe because they want to take advantage of it.
Mm.
So
yeah, of course, for their own use.
Exactly.
Yeah.
So it's actually not gonna increase the property to rent, because if you rent your property yearly, then you cannot go and take advantage of your property if you want to spend 2 weeks in Melbourne over Christmas because you've got family there and you don't want to stay with your family in their own house, because you've got your apartment there. So when,
of course. Of course. You're if you had that beach house, and we can put our minds back to 20, 30 years ago, where reasonably, before we saw this level of asset growth, reasonably a lot of Australians could have had, say, a beach house or whatever. And now they're just kind of earning a little bit of an extra buck for something that they might have had, an asset they might have had for 30, 40 years. But also, all the meanwhile, someone comes down for a week and spends $100 at the local cafe and $100 at the local bar, and your small IGA or greengrocer or something gets an extra $200. It does seem to me to have these unforeseen consequences, especially in towns where you might have a little bit of a populist backlash and say, oh no, we don't want Airbnbs here.
But that's one of the concerns. The Victoria's tourism sector is concerned by this announcement, because there is the tourism sector that is going to be impacted, I'm pretty sure. Yeah. But also, we've seen investors fleeing Victoria in droves last year. So is this going to keep them leave?
No, absolutely.
The
and the question is, when you do look at these things with a long-term pipeline, when you do have investors fleeing a state and investors moving states, at what point does this start to drain Victoria's government coffers? And at what point is the government actually going to have to implement meaningful cuts? Because the Victorian state government is just borrowing money hand over fist, because they're just amazingly fiscally irresponsible. And then you've also got a flood of investors leaving at the same time, it doesn't seem like Melbourne's going to be ripe for investment opportunities going forward, or even just a hub of economic growth.
Yeah, it's going to be interesting to look at and to keep covering for us.
On that, if you do think I'm wrong, please reach out, liam.garman@momentummedia.com.au. The way that, Emily and I are looking at this podcast is sharing some of our learnings, sharing some of what we're seeing in the market with our listeners and keeping you up to date with the latest information, especially all of this really only came out over the last few days. So do reach out, get in touch if you do disagree, and hey, jump on the podcast and learn me a little bit. Teach me, and I'm very happy to listen, because seeing some investment opportunities in the Melbourne market at the moment, I'd like to be told I was wrong, but I think that is all we have time for today. Thank you so much for joining us on the Smart Property Investment Show, and we'll be back in just a few days with another episode. But until then, bye-bye.
Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.